Welcome everyone who's joining us. We'll start in a few moments after some additional people get a chance to log on. So hang tight, we'll be back with you soon. Well, welcome everyone to DMCNY's Midweek Recharge. Today we're going to discuss the shifts in marketing spending due to COVID-19 and what to expect as we head into Q3 and Q4 of 2020. But before we get started, I'd like to take a moment to thank DMCNY's annual sponsors, whose generous support makes events such as this possible. So thank you so much to our platinum sponsor, Axiom, our gold sponsors, Weiland, Experian, and Alliant, and our bronze sponsors, BMI Global OMS, Japs Olson Company, and Epsilon. Of course, a little bit of housekeeping, as with every webinar. All of you will remain on mute, so if you have any technical issues, please use the chat box for that. And if you have any questions for our presenter, just go ahead and use the Q&A. You can do that at any time throughout the presentation, and we'll host the Q&A at the end of the presentation. So thanks everyone for joining us. I'm excited to present Bruce Biegel, who is Senior Managing Director of Winterberry, which I'm sure all of you already know. Bruce is going to share his forecast of which sectors are going to bounce sooner rather than later, and where he sees systemic change in advertising versus change simply based on the pandemic. So with that, welcome Bruce. We're so excited to have you today.
Ginger, thank you very much. Appreciate being here. I am going to share my screen and bring up a presentation, which will be available as PDF from DMCNY. Appreciate being invited today, and thank you to the sponsors as well in advance. All right. So, one PowerPoint slideshow. All right, I'm just going to minimize the folks in the corner. So this is the third outlook that I've now done since the start of COVID. I remember having an interview around March 15th where somebody said, well, what do you think is going to happen? I said, well, people won't be going out and they'll watch more TV, but I don't know much more than that. And then, you know, as you went through and we got to the end of April, April was pretty dim and dark. May started to get a little better, and of course, we're here in June. Just for those of you who don't know who Winterberry is, we're a management consultancy based in New York. I am actually coming to you from Miami today, which is where I live. Normally I would be commuting by plane, but not so much. We specialize in advertising, marketing, data technology, and commerce, doing growth strategy. And we are especially involved in the world of data these days, so I will actually do some focus in that area. Okay, so in January, I got up and I said, oh, this is going to be a great year. Looks like we're going to be up 7.2%, $389 billion of total spend across our offline channels and our online channels. Not everything was looking great, but we had Olympics on the way, and overall, you know, things looked good. Things looked less good as we got to around the 15th of March. I flew home from London the night of March 12th, right after they had announced that they were going to be closing the country up and closing the airlines down. And we really didn't know what to expect. I saw a great chart in April from Yelp, and it compared, you know, the impact of COVID to a hurricane. And we're now in hurricane season, and you watch. And so hurricanes tend to wipe things out, but they tend to come back more rapidly. However, I think what we're seeing is something that's going to take us much longer to recover. The first wave that we saw was unemployment rate. We watched the numbers climb. You know, everybody you had a lot of time to watch the news. We got to a peak of about 17%. We had about 25 million, 28 million people who had lost their jobs. There were waves of government support to keep businesses from shutting, but nonetheless, we're starting to see some recovery. And some will look and say, all right, we get at the end of May or in the month of May, we actually started to come back 2.5 million, but we still have 20 million people unemployed at this point. So we're going to watch that. Do we think the worst is over? We think the worst is over. Do we think it's going to be a long road back? Absolutely. While all of this unemployment was occurring and jobs were being shut down, the impact on GDP was pretty significant. We normally look at GDP and say, okay, there's a multiplier effect. Based on if GDP grows by 2%, we would expect 4% growth in advertising and marketing spend. Second quarter, first quarter, things fell off at the very end. So it wound up, instead of being up 1.7, it was down 5. That was just the early warning signs. Our latest numbers that we've gotten show that GDP could be down about 31%. The good news is, at least it's not going to be a 2-to-1 ratio, but it's a pretty horrific number. That's 3 times larger than the fall of GDP that we saw in 2008, 2009. And it's also harder to watch because different states closed at different times and different states are opening at different times. And we're hoping we stay open, depending on how COVID continues to evolve. But you get this kind of fallout in GDP, you're going to have that impact on the ad market. So I'll start with the digital channels. Display, and now display ads are not digital video, so it's a format. But display ads in 2Q down somewhere in the 30 to 45% range. When you're going to turn things off, turning off digital campaigns are probably one of the easiest things you can do. You either do it yourself or you tell your agency, all right, we're just going to turn it down. And in this case, because so much local advertising and national advertising, it shut. So we lost 35 to 45% for the quarter. When those first couple of last week or so of March, those first couple of weeks of April, it was significantly higher. It's starting to come back. It looks like around the 3rd week of April, you started to see some of the ad spend come back, and it's continued to ramp. Search, down 30% in that March-April timeframe, but for the quarter looks to be 20 to 25%. Again, it means that June is significantly better, so it's pulling the worst news out, but we're still down pretty heavily. Paid social, down. Digital video. So on March 15th, when I spoke to the press, I said, people are going to stay home, they're going to watch TV, which should be good for both linear and digital video and streaming. What I didn't take into account was when the news is uniformly bad on TV, you don't necessarily want to advertise next to it. All in all, though, as we've come back, that portion of the market has done okay. In a market down as much as this has been, being only down 5% for the quarter is a victory that people should be jumping and dancing about. Email, no surprise, email volume has stayed very high and actually grew. However, many of the brands went back to their agencies and to their email suppliers, and they said, yeah, but we need some concessions on pricing. So what we saw was a growth of volume, but effectively flat spend, so that revenue or cost per email, actually declined. But again, that's a victory in a market like this. Then we turn to the offline channels. So the first offline channel is linear TV. Linear TV, minus an Olympics, minus sports, etc., severely impacted, looking to be down 25–35%. $10 to $12 billion coming out of a $65 billion market in the first half of the year. That is a very, very significant downturn. Spectator-free sports just started to come back. Golf last weekend. As we sit here right now, there's a Premier League match of Manchester City and Arsenal being played. And what was interesting when I turned on the match, just in preparation for this, was that they're piping in for the viewers crowd noise, even though nobody's in the stadium, to make it feel like more of a live experience. Probably the next sector that was hit hardest was direct mail. The UPS mail volume from their monthly reports was down around 45% for ad mail. We spoke to a number of print letter shops who saw declines of up to 60% in April. The good news is it's starting to come back, but to offset that kind of decline, you're going to have a fairly robust June. It's helping, people are definitely seeing mail coming back, but with nothing local and most national on pause, that's a significant hit to that sector of the industry, but not necessarily as bad as experiential. With the events gone, the tournaments gone, the Olympics gone, and everybody staying at home, you're not having a whole lot of experiential physical experiences. And we really don't know when that will return, but that market is down 75% plus. We have not seen any hard numbers coming back. The numbers really will lag. I think one of the challenges in any forecasting in this environment is you just don't know, and it seems to be a month-to-month event. But much of that was turned off. We recently dropped a survey with the IAB. The question was, how much of a budget cut? The state of data report that should be out in the next week or so, it's going to be down. It could be over at least this quarter and next quarter, down 10 to 20%. So third quarter, when we think about the numbers that I just spoke to, this quarter will not be as bad, but it is the next quarter won't be as bad, but it's still pretty rough. The questions that have been asked is, when does it come back? And half of the people said, hey, it should start again in Q3. I really do think it's started already. But, it's going to be one of these things that builds as states reopen, as businesses start to come back, as people, as brands feel comfortable spending, we'll start to see that ramp, but we're not coming back all at once. But we do believe that it's bottomed. Magna, which is part of IPG, gave their ad spend forecast earlier this week. And it was one of the first that really said, okay, this is what we think happened. On a global basis, they had been forecasting a 6.6% up. They're more on the media side. So and we cover more channels than ours, but they've gone from 6.6 up for the year to down 4.4%. And on a global basis, that's taking about $100 billion of global ad spend out. They expect that this will continue for a while, but part of that will be dependent on what kind of recovery we see. So the recovery question is that we're getting from our private equity clients and from our brand and supplier clients is, what does this look like? You know, are we going to get a V? Stock market looked like it had a V. It's turning, you know, it's kind of a V, but maybe not a V, and there's no sustainability there. We don't think it's a V. We think it looks more like an elongated U. Somebody called it a Nike swoosh. Some people say it looks a little bit more like a bathtub, or you've got the deep end of the swimming pool. Whatever it is, Q3 is going to be better than this quarter. We think maybe 20% better. We think Q4 is going to be better. We're looking at that annualized contraction of GDP somewhere in the negative 5.6% range. We think that's most likely. We think that positive GDP growth is likely in the first quarter of 2021, subject to a whole list of pandemic-related issues, as well as other issues that I'll get into. But all in all, you know, I think the consensus is coming out. First half of next year, life will start to look a lot more normal. That even though we see improvement the rest of this year, playing catch up is going to be pretty hard. Have we seen this before? Yeah, not all verticals were impacted alike. I'm going to speak to that in a second. Not all of them recover at the same time. As we can all see, social and economic inequalities have intensified. The stock market coming back the way it did, while so many people are unemployed, create even a larger gap. You know, what kind of changes will we see? Changes take time. Changes take a will of government, and we have a fairly fractured government right now. But I think there's more will in the people. And the other question is, have we reached a tipping point? We have been watching traditional media, starting with newspaper, magazines, etc., declining for, you know, going back to 2006. It's been a fairly steady decline and shift. TV held up extremely well during that 10, 12-year period and had started to see some shifts as money shifted into other forms of digital video and advanced TV. We do think that this event is going to be yet another big push away from traditional, away from linear, away from print, to compound what has been going on. All right, some of the verticals. Retail. Accelerated shift to e-commerce. If you can't go out, you shop online. And not everything shopping online works particularly well. But a lot of things do. Things that you probably, you know, out of habit would not have bought online. Dog food, cat food, litter, things like that. People are getting used to the fact that, you know, I could just order this and it shows up at my door, and maybe that's easier. We're seeing, you know, people come back to stores slowly. We're seeing brands that were on the edge coming in that have gone into bankruptcy, significant numbers of brands. We think overall 25,000 US stores are likely to permanently close, taking those jobs with them permanently so that unemployment rate will stay high. Malls being hit pretty hard. And even as things came back, getting the products you wanted, because our supply chains stretched around the world, was pretty difficult. Direct-to-consumer marketing is on the rise. We expect, you know, we're seeing and hearing from brands that have never been direct-to-consumer, that missed catalogs, that sold through companies like Target and Walmart, et cetera, coming and saying, hey, we need a D2C model so that we can have more control of our destiny. So we're seeing some pretty significant, what we think are not cyclical changes, but systemic changes in retail. Financial services did better. It held up. We think the banks, banks never really closed down. Obviously, if you tried to call and get to a bank in the month of April, good luck with that. It was taking forever. The brokerage market stayed relatively stable. But there's a shift away from cash. And the banks, when you get a scenario like this, people in need of money show up. So all of a sudden, the creditworthiness of people coming to that bank looking for loans, et cetera, which they may have been fine a month before, they are much less fine. So we're really watching how credit risk moves this market. But overall, while marketing turned down, the industry itself seems to have held up with support from the government pretty well. The auto market turned off. The factories shut down. It was about the third week of April that the dealerships down here in Florida started to open up. And if you had a car that was on lease, like I did, you went to the dealership and had to get a new car. But it's taking a while, for local dealer ads to come back. We've now, I think May, we've seen a pretty full return. The factories have come back online, but we're definitely seeing launch delays, and we're seeing new digital approaches in the car buying process. A lot more time being spent online before you go to put yourself in the seat of the car, because you want to minimize the amount of time you're going to spend at that dealership or the number of dealerships. So auto coming back, but slow, and of course, long supply chains that extend around the globe for parts. So harder for it to snap back. And so we think that's going to we'll see a slow, steady build over the course of the year. Media and entertainment, live entertainment, who knows? It's going to be a while, and the promotions are going to take a while. On the other side, streaming services, we saw Disney Plus launch and pick up 50 million, subscribers in no time at all. We think we will continue to see that shift to subscriptions, but ultimately, how many subscriptions do you need? And once you start going out, sorry about that. Once you start going out, it becomes, you're going to reduce the amount of time you spend. And people will start to look and say, how much money should I be spending on those streaming subscriptions? Spectators, free sports, a lot of money, a lot of local video spend is tied to local sports. That's not happening anytime soon. So we think subscription growth slows. Spectator-free sports will actually be okay once they start, because the local video ads will come back because people will watch. Even if you can't watch at the game, you're going to watch remotely. And obviously, we're seeing the impact on how movies are released and when movies are going to be released. Healthcare and pharma, one of the bright spots. As I spoke to agencies and brands within the sector, they were fine. It's one of the few areas you're shopping. You're shopping for groceries more than you've probably ever shopped for groceries, because you're no longer going out. Things that you went to, where you went to the grocery store, you went to the pharmacy. So healthcare and pharma did okay. And we expect they will continue to do fine. But they were one of the real exceptions in this market. But again, even there, those supply chains and new drug, everything has focused on COVID. And it's only now that we're starting to see the return of the advertising at the local level for the pharma and elective surgery markets. So did well, somewhat positive, not great, but compared to everything else, great. Travel and hospitality, some of the numbers we heard were 90% drop in travel and lodging. Even now, 3 months in, the hotel numbers for occupancy, if they were averaging in the high 60s, in the United States, they're in the high 30s right now. And until people decide they're going to travel, we're not seeing a bounce. More people are traveling by car, but there's not that comfort level. And frankly, on the B2B side, we're wrestling with how do you start traveling again? Our clients in the Midwest are opening up, unlike our clients in New York, and people are coming back to the office. But do they want, people to come who are not part of their office? Are they ready to handle that? But in some sectors, it's okay, let's go back. And we are going to see a slow return in the third quarter, but we think it's going to be very slowly. And we think this continues well into 2021. And there are some brands that have flat out said our people are not going to travel. And we're not going to welcome guests into our offices. So this, we think, will be the most impacted sector as we go through the year. Okay, so I always do our trends every year, so let's highlight some of the key trends. The experience economy, well, it's more digital than ever without the physical side. So a lot more focus on curating content, on personalization, on digital experiences. Though there's a question, how many webinars can we watch? Thank you all for coming today. But it is a real question of how much we can experience without physically being there. I think the number I saw earlier this week was 83% of marketers said that when physical experiences and conferences and events return next year, they will be ready to return. Influencer marketing, which had been growing somewhere in the neighborhood of 40 to 50% quarter over quarter, all of a sudden started to slow significantly, 33% cut in spend. So in line with a lot of other advertising spend, but a lot of the micro influencers got hit harder. I think brands are reassessing how much money they were putting into influencer marketing and to do a better job of validation, because there were a number of stories of influencers who pretended they were somewhere and never were. So removing some of the fraud from that market, I think, is going to be pretty important. In the push to direct-to-consumer marketing, what we call buy direct, commerce spending up 30% year over year. Do we think that growth rate is sustainable? No. But do we think most of this, will carry over into the longer term? Absolutely. The other thing that we were watching pretty closely was the way money is spent to build D2C brands. And social media was getting increasingly expensive, which is along with search, their go-to channels. And what we're seeing there is, because of lower CPMs, because advertisers pulled out, it was easier for e-commerce brands to go back in and less expensive. Advanced TV, as I've been talking about, and we define advanced TV as addressable, OTT, and connected TV. So those three pieces fall into advanced TV. Again, we believe that more urgency among marketers to be better at how they're leveraging the channel, because there is much more of a shift. Whereas the other part that we're seeing is as a big shift, and we think is a big opportunity, is video games. 60% increase in gaming. And if we've been following some of the trends around, we need first-party data as we think about where the market's going, well, those people are logged in. And they are permissioned. So we're really watching this sector as, like advanced TV, a systemic shift in spend, but obviously, again, time spent will slow down once people go outside again. Mobile data traffic up 380%. Obviously, we're sitting there, we go from our phone to our tablet to our computer to the shared TV in the house or TVs in the house. So we're watching people spend more time on their devices than ever before, even if that mobility is, I'm just moving from one room to the other. But again, if I want to maintain that experience as I go from device to device to device, that's not as easy to be consistent and track people as they go in and out of walled gardens. So as you go into a Facebook experience and come back out, losing track of people, is hard. So this is something that we believe the industry is really going to have to focus on in the second half. And it's got some tailwinds and some real headwinds. Analytics. So at the beginning of the year, 280,000 open positions on LinkedIn for data analysts. 21,000 as of the end of last week. But they're still open positions. But that is an incredible shift. However, over half of marketers and publishers say they're going to need more services around modeling and segmentation. And the back half of this year, we expect to see the open positions and that focus increase even more. When you're putting out so much digital content, being relevant becomes really important. And when everybody's working remotely, it's also not so easy. And everybody had to rethink their approach because of the COVID and then the other issues in the market. So we went from a pandemic market that you had to work your way around. We've gone to a Black Lives Matter and social unrest, which you need to manage and think your way through. And you need to reform your messaging. If you weren't there before, you have to reform it now. And we're seeing brands take this seriously. So I think that's pretty fantastic. Loyalty. When you have a wallet recession like we've got right now, people are going to be less loyal. They're loyal to savings and tangible value. And if we were shifting to more of an experience loyalty focus, well, obviously that's been pulled back as well. Look for more partnerships going forward. Okay, a couple of areas that I want to spotlight and highlight as we think about the next 6 months coming up. Privacy. So in January, it was okay, CCPA is here. And we need to be very aware. I think the industry has done a good job of looking at CCPA compliance from a data industry perspective. People have become less concerned with privacy shutting down our market, but it's still privacy and privacy regulation is a challenge, but it's nowhere near the challenge and the concern that people felt 6 months ago. Enforcement just starting, so sentiment could change. Because we're doing so much work in Europe, we're now 2 years into GDPR, and it has changed how marketing is done, both in the offline world, as we've lost identifiers, as we've lost data that was available for marketing. But it hasn't stopped marketing. We still saw growth. It's just that you have to market and think about how you leverage data differently. And you have to think about, what does a privacy-first environment really look like as a marketer? But we're not seeing a reduction in spend on data. Now, you may be looking as a data provider and saying, well, I just saw a fairly big reduction. But remember, data is used to power marketing channels. And so as the channel spend goes down, the percentage of data didn't go down. It's just data spend in general. So we've been watching that. The kind of the last note, as we surveyed the data providers on CCPA, the opt-outs, through May were in the low tens of thousands. They were not in the hundreds of thousands or millions of people opting out. I do believe that a lot of people don't, when they see that box that pops up that says, do you accept cookies? Most people just click accept. They're not really reading through, even if the text has gotten broader. It went from accept or not to now there's like a paragraph at the bottom around permissible use. We do think that the money will continue to flow into the sector, because even if it's one person who's opting out, if you are not prepared to provide what data that you've collected on people and to allow them to opt out, and so that mechanism, that technology, those services that are required, if you're not doing it, the penalties can be pretty strong now that we're into the enforcement phase. So you have to be ready, even if it's not going to be a large number of folks. You need the compliance. We just finished 2 months of identity interviews. I think I spent 80 hours interviewing across 60 companies, over 100 people in North America and Europe, as we get ready to launch an updated identity paper next week. The couple things came out. One, there's a significant change in identity that is about to happen. Two things. We have the regulation of GDPR and CCPA, making providers become much more consent-oriented. And the second, on January 15th, just about when we were at the last CNY Outlook, Google announced the deprecation of cookies. And so they were not the first. Firefox had already said no more third-party cookies. Apple had already removed third-party cookies. But Google, which had about 60% share, said, okay, by the end of 2021, third-party cookies are going to be gone. Now, we have built an audience ecosystem in digital marketing around first-party cookies, which says, okay, we're going to need some pretty significant shifts. Where do you have rights? You have rights to your first-party data, the data that direct-to-consumer brands have, the data that catalogers have. So this is not new, but all of a sudden that focus of, I can't just rely on a third-party ecosystem, has changed to a first-party data focus. And it's really driving changes at the enterprise and publisher level. I don't think we're there for mid-market and SMB. Lots more on this topic to come. The other thing is we're seeing more new approaches, many of them coming from Europe, who had to adjust to GDPR first, in how identity is going to be managed and how identity resolution is going to be performed. So we're watching. I think one of the things that we're thinking about is, how many solutions do we need? Will there just be one? The answer to that was no. But there is a question of how many we'll need. The other thing to think about in identity in the personalization market, on your own website, in your apps, etc., you have one set of solutions. Identity in the programmatic digital ecosystem, you'll have different solutions, because you have a different way of buying and a different way of leveraging audience data and different rights to that. And the third is, as this advanced TV ecosystem grows, it was never cookie reliant. So we now have to figure out, all right, is there one identity solution, or am I going to have three, or am I going to blend? But that first party data is going to be in the middle. So we're dropping the paper next Wednesday, so a week from today. We also, in one of our recent surveys, asked people, well, are you going to reduce the data that you're buying? And the answer is no. Very few people are saying, okay, because of the new regulations, we're going to stop buying third-party data. it's going to be done different. And if you're not privacy compliant, you are going to have issues. But for those that are CCPA compliant, you know, the brands are not coming and saying, yeah, we're getting out of, we're stopping. We're not going to buy data anymore. That's not the case. But again, privacy first. In the technology world, Mr. Brinker came out and, you know, about a month or so ago and said, we're now up to 8,000 advertising and marketing technology solutions. There's a lot of different tech. I'm not going to focus on 8,000. I'm going to focus on a handful. The first is we've had this tech stacks versus point solution debate. I think I've been talking about it for 10 years now. We went through all point solutions. Then when it was, you know what, stacks are so much easier. I think, you know, our research is telling us that assembling the right stack for your company is probably where you want to be. But stacks are going to wrap themselves around a central data management solution. Many things can be swapped in or out, but that central data solution in the middle is going to be pretty critical. In addition to that critical nature of that of the data management piece is how do you decision on that and how do you orchestrate across the different channels so that I can be seamless and consistent and deliver that right experience. Well, like we found in identity, and seriously, we had 60 different definitions of identity as we went out and spoke to people. In the decisioning market, where we are also doing research, you get different definitions based on whether you're coming from the ad tech world or the MarTech world. So one, we've got a split. I think where people are coming together is I need more real-time decisioning and I need better orchestration tools. And the folks that are actually doing the best job are mid-market companies because they don't have the silos. So they're not, okay, wait, this is my decisioning over here in ad tech. And the ad tech people live over in the media group. And the MarTech people are over here doing direct mail and email. You tend to have a smaller department. So without the silos, they've been able to do a better job of looking at prepackaged solutions. Overall, we think the market's not in the early adoption phase, but they're learning how to use the tools that are available. So we think it's very immature. Stay tuned, end of July for our decisioning white paper. As we think about agencies, so our agency clients were hit pretty hard. Not across the board, there were some bright spots, but mostly it was it was not good, from slightly negative to very negative. The slightly positive, if you think back to the verticals, if you happen to have been in healthcare or you were in CPG, you were probably okay. If you had a whole bunch of travel clients, that money was turned off. So campaigns, easy to turn off. We're seeing them turn back on. We're not seeing them turn back on with the same level of spend as we did before. The earnings announcements, from the agency holdcos, you could see their first quarter numbers. Those last, 3 weeks of March really hurt. Across the board, we saw furloughs and layoffs, reduced hours, reduction of contractors, staffing shifts, pay cuts, and this is pretty much on a global basis. Our clients in Europe, feeling just as much pain, and it's hard. Even if you've got the right and you're perfect at blending your accounts across verticals, in a market like this, it's impossible to say, okay, we're situated well, unless you happen to be a very vertical specific agency, perhaps in healthcare. But even then, we've seen impacts in one side of the agency while the other side was doing fine. You can't just move people back and forth that easily. So hard hit, the independents, hard hit as well. Starting to come back, PPP money for the independents really helped as a bridge. We don't know if we're done. I think that's kind of the net on that one. is there could be, depending on how quickly spend comes back, as that PPP money runs out, do we see another wave? We're watching. Where we saw the biggest impact, media buying, which is coming back. Shopper marketing is coming back slower. Experiential, obviously, most severely impacted. And again, depending on what sector you were on. Least affected, PR seemed to have held up pretty well. Web design, agencies that had that heavy CPG tech, healthcare, agencies that were system integrators, a lot of the management consultancies, some of that work, if you were already in flight, that work didn't stop for the enterprise brands, because if you lost the team that was doing that new e-commerce or Adobe Experience type of implementation, if that team went away, you might not get them back. So we saw a lot of continuity in certain areas, but if it was campaign centric, that's where we saw the most pain. M&A, which was cruising along nicely, pretty much froze from third week of March until probably the middle of May. In the meantime, more capital was being raised than we'd almost ever seen before. So massive downdraft on deal volume, but now big piles of capital sitting on the sidelines. People are starting to look for deals. The problem that you have in terms of doing deals is if you're going to go buy a company, you really want to meet the people you're about to buy and that you're going to be working with and living with for the next several years. And until the travel unfreezes and you can get out and see people, it's hard to see that come back. But from our conversations with bankers and the lawyers and the private equity firms, we're starting to see that. We see that accelerating into third quarter. We're seeing reduction in valuation. So the multiples have compressed. And obviously people's profitability is down. So we think that we'll be in this imbalance period through the rest of the year and going into 2021. Outlook for recovery, medical. Will we get a vaccine? When will we get it? When will we get treatment? So my sister happens to be in this field. She's a scientist in a personalized medicine lab. And she said, if we get treatment so that it's like getting the flu, and you go to CVS or Walgreens, whatever, and you pick up a bottle of, COVID Theraflu, and it's no longer as critical, people will be less concerned, and life returns to normal. Obviously, if we get a vaccine, we're in better shape. But without those two things, very, very difficult to forecast what happens. The wallet recession, with this many people out of work, they are burning through their savings. So even as they get their jobs back, there's a hole in their income for the year. And they won't just go back and start spending. It took a long time after 08, 09 for people to be comfortable. And then finally, the policy issue. When do the schools open? When do people come back to work? How do we come back to work? How do we travel? A lot of questions. There are a lot more questions right now than there are great answers, no matter what the politicians have to say. A couple of things that we think are long-term. This acceleration in the shift to digital, we see this as systemic, not cyclical, and we are going to, just like 08, 09 gave digital a kick forward, we think this gives digital another kick forward and hurts traditional. We think that it's going to take a while for recovery. I remember looking back at some of my presentations and the numbers of the spend levels we were at in 08, 09, we didn't get back to that same dollar value until probably 2013, 2014, something like that. So it was a while. And there's going to be margin pressure that comes along with this. The other one we're watching is in-housing. In-housing, requires that you've got good growth and you're looking at your spend and you're saying, hey, spend keeps going up. Maybe I should bring this in-house because I could be more efficient, et cetera. Well, when you get a recession like this, companies go back to their core. And we think that we'll get at a minimum, we've got a temporary slow in in-housing efforts. And the question is this a halt or a delay? And I think there are other implications as the digital media ecosystem changes and cookies are deprecated and regulation, does the market get more complex? So we're really watching this trend and its impact over the next 6 to 12 months. Finally, a couple things to think about. As you are going through this is the time that you look at your business and say, do I come back the same way I was? Does that make sense? So you look and say, am I positioned for that next wave of growth when it returns? How do I need to change my operating model? How do I have to transform my business so that I do a better job with these systemic changes to the market, this shift to digital, the shift to privacy first, the shift to direct-to-consumer marketing? I need to understand how that impacts my business. And what does that do to my marketing model? As a brand, I'm now looking, am I staffed appropriately? Do I have the right blend of agencies? Do I have the right data assets, the right technology? This is the time to look at that, not 9 months from now. So we think that the next 4 or 5 months sets the tone for 2021. Final note, as I said, the Identity Outlook, Evolution of Identity in a Regulated Post-Cookie World, will drop next Wednesday. We are waiting. IAB will be dropping State of Data 2020. That should come shortly as well. And then, without a cover, the Deconstructing the Role of Decision Orchestration will be out at the end of July. So stay tuned and check in with the Winterberry website starting next week as these reports. It's been a lot of hours. Probably the advantage of being locked in Zoom for 2 months was we had that opportunity to survey people and have a lot of conversations that under normal circumstances I'm not sure we would have gotten to. But this has been this has given us that opportunity to go back and really re-examine the market. All right, and on that note, we are done. And I will stop sharing and return us to Ginger.
Awesome. Bruce, thank you so much. So much excellent information and insight. I really appreciate it. We do have a handful of questions, so let's dive into those. With D2C and dual model advertising, how important will brand personalization be going forward? Will this lag behind firms getting their CDP acts in order?
So you need your data management. It's great that you go and collect all this first-party data so that you can do this direct-to-consumer marketing. If you don't have it in a data environment like a CDP or a CRM platform, et cetera, it's going to be very hard to do personalization, and you need to be better at it. As we go more digital first, as we go more direct-to-consumer, and it's not just on my digital touchpoints. It's going to be as we return to stores. It's going to be on the website, in the app, in the store, and being consistent. So we think it's critical to get your CDP house in order.
Absolutely. Another prediction question for you. I'm going to combine two into one. Any prediction on the future of malls and the future of movie theaters?
So movie theaters are starting to reopen. I've seen some pretty weird pictures of movie theaters with half the chairs pulled out in order to provide social distancing in the theater. So reconfiguration, it's an experience that people are not willing to give up. As many, watching the little screen is not the same as the big screen, but it's going to take time.
Yeah.
That it's really a vaccine issue as much as anything else. With respect to malls, malls are hit hard. When you lose 25,000 stores and multiple major chains are closing stores, even if the chains aren't bankrupt. You know, many of those were anchored in malls. And so the second anchor in the mall was restaurants. And people are not going back to restaurants. So it's a challenge. And malls have to rethink what kind of space they're going to be.
Yeah, absolutely. And related question, for retail, which segments will be on the rise faster? For example, home improvement versus apparel?
Home improvement didn't do badly at all because they were deemed essential. And guess what? Everybody was home, so they did their home improvement work. So I think home improvement weathered the storm pretty well. Apparel took a huge hit because most people, I haven't put on shoes in 3 months. Put on sneakers, but I haven't put on shoes, and because I live in Florida, I haven't put on jeans. You know, so nobody's going out and doing a whole lot of shopping. It's starting to come back. We're starting to see it slowly pick up. And frankly, you know, some forms of apparel are very hard to do without shopping. You know, so physically being in there, we sent back, I watched a lot of boxes of sneakers come through the door and then go back out to UPS because nothing fit quite right. And you couldn't just send them, I'll just go in the back and find me the other pair. Doesn't work so well.
Right, exactly. Yes, had that experience. All right, another question for you. Do you see an incremental rise in the use of analytics, particularly B2B, based on emphasizing data-driven decisions and models and assessing COVID impacts?
Absolutely. You know, if there's one thing that we know, more analytics, not less, as we have, and more complicated, because we're going to have access to some identifiers, and then we're going to lose access to things like cookies. So attribution is going to be harder. Measurement is going to be more complex. We're going to go in and out of walled gardens. You know, you lose that visibility. So in order to do measurement, optimization, et cetera, you need more talent. It's not just going to be solved by the machines. The machines are getting better, but the machine needs to be trained.
Right. So obviously we've got elections coming up. Any impact in the USPS in terms of not only all of the political direct mail, but also mail-in ballots?
So political direct mail will come back. This is going to be a very contested election. We obviously have a White House that does not like the post office, but at the same time, nobody wants to close a post office. So they're going to have a tug of war. We have dysfunctional Congress. We do think that the mail's going to get hit pretty hard. Revenue somewhat offset by an increase in package delivery, but nonetheless, this is going to be a tough year for the post office.
Yeah, absolutely. Well, we are pretty much out of time, so apologies to the folks whose questions we didn't get to. But Bruce, thank you so much again for your time and all the terrific information today.
Thank you, Ginger. Really appreciate you having me here. We'll see what I have to say when we get 6 months from now, and it's the middle of January again, and we're thinking about hopefully in person in New York, and we're looking back and saying what really happened.
Yeah, definitely. And I want to thank everyone who's here with us today for joining. I just want to also remind you, next week we have someone also amazing, Katie Martell. She is known as an unapologetic marketing truth teller. She's going to be examining marketing in an age of civil unrest and uncertainty, talking about the difference between meaningful support and pandering, the risks of performative brand allyship, and how to navigate in an age of accountability, cancel culture, and hashtag activism. So be sure to register and have a great rest of your evening.
Thank you. Have a good night. Hopefully see you all soon.
Yes, thanks.
In person. All right. Bye-bye.